This is Daybreak Asia. We're counting down to Asia's major trading opens. Japan and South Korea just a few moments away, but also taking a look at some live pictures we have right now going to Beijing, where we're awaiting Chinese Premier Li Qiang's annual work report that he's going to be delivering to Parliament's opening on Tuesday. Those live pictures there are very much awaiting that, Heidi.
Yeah, that's a great haul of the people right there. It's really an interesting time to be in the capital. Of course, security is high, the scrutiny is high, and we're seeing some journalists just being in that area, including, of course, our very own Steve Engel, as we await this GDP target. But, of course, also things are different this year. The economy is slowing. We didn't get that kind of true rebound of COVID, and we're not getting that press briefing from Premier Li Qiang, which is, is really some consternation for investors.
Yeah, it certainly takes away a rare platform to learn more about policy direction. But what we're also looking at here is the open we have for Japan today. And we're just retreating very, very, very modestly from that 40,000 level we hit for the first time ever on Monday in the session. Part of the dynamic, of course, we had the Wall Street session overnight. It was wait and see. Traders are looking ahead to Powell's testimony coming up later this week. We've got US jobs data. So these are going to give us clues on the direction for the Fed, of course. But then also in Japan, we're taking a look at the impact of price pressures there. We had core consumer prices for Tokyo. This is the leading indicator, but rising 2.5% on the year. So a sharp acceleration, but still base effects coming into that because we had energy subsidies sort of masking the numbers this period from last year. But that's the outlook there. We did actually also have Japan's finance minister just speaking a few moments ago, saying that they're not considering calling an end to deflation either just yet. And certainly the view from the economists that we speak to is that the BOJ is likely to shift. Our own team at Bloomberg Economics saying that'll come through at the midpoint of the year. But the outlook for equities here, you're just seeing them a little bit under pressure here. That Japanese yen continuing to hold around the 150 mark. Let's shift now to what we're seeing for Korea at the start of trade, because we have the Kospi just coming online here again. A little bit of weakness coming through. We had those fourth quarter GDP figures out an hour ago. And again, it was that expansion to 2.2% on the year and about 6.6% on the quarter here. But still a little bit of weakness that we're seeing in the equity space so far. Korea, one of the markets that's really trying to take away those lessons from Japan in terms of corporate governance reform. And that's certainly been one of the factors that has driven Japanese equities even higher. But let's bring in our next guest, who says the investment case for Japanese stocks is still intact. With us now is Tai Hui, Chief APAC Market Strategist at JP Morgan Asset Management. And interested for your views, of course, that big run-up that we've seen over the course of this year and last year as well. Do you think that we can still see further gains ahead? Momentum for Japanese equities does look to be stalling a little bit.
Well, I think so. I think if you look back to the last 12 months, I think the Japanese equity has been driven largely by a value rally, where obviously a lot of cheaper companies were encouraged to improve their valuations, improve the performance, and to some extent, a lot of them have delivered. But at the same time, you saw a lot of growth companies have been lagging behind because investor sentiment or investor focus has been on those cheaper companies, for example, utilities, real estate and banks. But a lot of tech companies, healthcare, consumer discretionaries, they have not performed as well. So while we do think that the Japanese economy may be taking a breather for the time being, earnings outlook for some of these growth stocks continues to be quite encouraging. Valuation is reasonable. So from that perspective, I do think that from a portfolio construction perspective, there's definitely a place for Japanese equities to play a role.
What do you think, though, about the direction that we see for BOJ policy direction, and how is that sort of likely to change the calculus at all? We just had those Tokyo inflation numbers coming out, that base effect playing into it, but still it was that acceleration.
Well, we do think that BOJ is moving into the condition to raise rates sometime in the second quarter. So that historically is a very important step. But overall, if you look at the futures market or the OIS market, is pricing in somewhere around 25 basis points for the whole of 2024. So the increase in interest rates in Japan in terms of magnitude is likely to be very small. And as a result, I don't think that's going to be a huge driver for where Japanese yen is going to be. So Overall, I think the BOJ's policy changes in the next few months, again, historically it's important, but for the stock market as a whole, to me, is still the earnings and the valuations and also the increased interests by international investors that's going to be the key.
Taehui, the momentum play for Japan is particularly a standout, even as you do kind of see that playing out across other major markets. But take a look at this chart, which kind of shows you just how big that narrative is for the Japan rally. Does that worry you? Because are we getting to a point where, the stocks that have done well are just doing even better, and we're seeing underperformance for a lot of the rest of the market? Where are the opportunities in that case?
Absolutely. So I think there's a case for some consolidations on those outperformers. And at the same time, what we would advocate is a bit more active selection in companies that can deliver long-term earnings growth. Now, we've been talking about markets like Taiwan and South Korea that benefited from the AI boom on the hardware side. Don't forget, a lot of Japanese companies are also very competitive in technology, on entertainment, on healthcare, that we think can deliver earnings in the longer run. And frankly, these companies have underperformed to some extent in the last 12, 15 months. So while instead of just chasing the value rally that we've seen because of improvement in corporate governance, I think on top of that, we can add a little bit more on the growth style in Japan. I think that will benefit quite nicely to the ongoing AI boom, as well as the ongoing earnings growth for these companies.
And of course, we're watching China on a day when we get Premier Li Qiang's work report, no press conference, which, I'll get your thoughts on that in just a moment. But we are getting, though, the expectation that the Chinese GDP growth target this year is around 5%. We're hearing that from both Reuters and Lianhe Zaobao as well, saying they've seen a transcript, reporters have seen a transcript that around 5% target will be disclosed during the work report to be released by Premier Li Qiang this morning. So look, that wouldn't be a surprise, around 5%. What do you make of that? Because clearly there's sort of conflicting priorities of wanting to instill some confidence, not wanting to set such a rigid and high target that they potentially run the risk of failing to meet it without sufficient stimulus.
But I think 5% is largely what the market is expecting right now. There are two things I think is going to be critical to improve the appeal of Chinese markets, Chinese equities. One of them is stabilization of the housing market, obviously. The other one is the ongoing improvement in corporate sentiment, and especially how the government implements its policies with regards to the private sector or private businesses. So I think, the conditions for these things to improve is slowly put in place. We do need more time for this confidence, both for the housing market and the private sector, to be rebuilt. So I don't think there's going to be a miracle cure per se coming from this the Party Congress. But at the same time, I do think there's a lot of pro-growth, pro-stimulus policies to be expected to come through as a result of these meetings.
Taehui, always great to chat with you, Chief APAC Market Strategist at JP Morgan Asset Management. So around 5%, largely unchanged from last year. China targeting that 2024 GDP growth target of around 5%. We're hearing that from both Reuters and local media, Lianhe Zaobao there, according to reporters that have seen that transcript ahead of Premier Li Qiang's delivery of that work report. Remember, we may get scant details in terms of the reasoning and the forecast and guidance, given that that press conference has been scrapped for the first time in 30 years. You are, of course, looking at some of that political pageantry that we associate with the two sessions this time of year every year, as officials, military, top brass entering the Great Hall of the People, just adjacent to Tiananmen Square, of course. Very close by is the Forbidden City as well. And that is, of course, where we'll also find our Chief North Asia correspondent, Stephen Engel, who's on the ground just outside the Great Hall of the People. It's very cold, but we do have a little bit more certainty of that GDP target.
Yeah, they do love their political pageantry, as you rightfully said there, Heidi. And yes, we're hearing from local media as well as Reuters who have seen the work report. Apparently, they are going to stick with that growth target of around 5%. That was the same target that they gave last year. And of course, 2023 was extremely challenging year for the Chinese economy on multiple fronts. So this growth target, some people ask, why do we care? Why do we need to have a growth target? Well, at this this time of a slowing Chinese economy, if they gave a target, say, below 5%, that would show pessimism about their prospects for rejuvenating the economy. But giving the same target, the way we read into it is that they believe that they have the tools, whether fiscally, monetarily, or, from external factors, exports, which have obviously been in a deep contraction, as well as, of course, the deflationary scenario. They believe that they can perhaps get that around 5% GDP growth with the tools at hand without perhaps a big bang stimulus. And that's something we'll be watching today at 9 o'clock local time when Li Qiang, the premier, gives his first work report as premier to read whether there's going to be certain support measures for property, stock market, and other areas of the economy that are suffering.
Yeah, I think it's been pretty clear from a lot of people we've spoken to, Steve, and including your commentary as well, that it's going to be very difficult to meet that 5% given the base effects playing into it from last year. But what we do know as well, that we're going to get that work report, but we're not going to get the press conference to follow. So talk us through the significance of that.
I find it significant, but not unsurprising, right? Or not surprising, because essentially Xi Jinping has ripped up the playbook on the political norms for the last 30 years or so. After Mao Zedong's passing, there were certain protocols and procedures that were put into place for how to run the government. Xi Jinping has changed a lot of that. Heck, we have not even had the third plenum, which was supposed to be held in the autumn, which is the third plenum is the forward planning, long-term planning for the economy. They never held that, so we were not able to read the tea leaves from that meeting for what will be sort of cemented here at the National People's Congress. And so now with Li Qiang, the premier, not giving a press conference, which has been tradition at the end of the National People's Congress, which would have been next week, either Monday or Tuesday for that press conference. It's the one opportunity that local press, international press, any press that are there are able to ask direct questions to a top Chinese leader, the premier in this case. Obviously, Xi Jinping does not give interviews, but the premier traditionally, whether it was Wen Jiabao 2 terms ago, or obviously Li Keqiang more previously, they were able to talk about the issues and kind of explain the policies. We're not going to get that. And that's been one of the big complaints about this current government is that there's not been a lot of transparency on communication and, of course, policy making. And that is why there's been a lot of hesitancy from international investors coming in. Foreign direct investment had the smallest increase in 2023 since 1993. And again, that Goldman report, which we've been talking about all morning, essentially when we had the economists from Goldman talking on Bloomberg television, I believe yesterday, essentially saying clients are all asking, is now the time to get into China? And Goldman Sachs, this particular person's response was, now is not the time to invest in China.
Steve, we're also getting some more reporting from local media as well. Lianhe Zaobao now saying that the 2024 budget deficit at 3% of GDP. I think this is quite interesting because 3% was the original target for the fiscal deficit for 2023 as well. It will be this, according to Lianhe Zaobao, for 2024, but the revised number for last year was actually 3.8%. So does this potentially suggest to us more of a focus on fiscal responsibility, which could be disappointing for markets and investors hoping for more fiscal support?
This tells a lot, actually, because there was a lot of speculation that the fiscal deficit, so ratio to GDP, would be much higher or a little bit higher than the 3% last year because of the fiscal needs to stimulate the economy. But this kind of underscores Xi Jinping's emphasis on de-risking and deleveraging, and that they're not necessarily going to throw everything, including the kitchen sink, at the problems right now. So we'll have to wait and see how Li Qiang explains this, but also there's also fiscal spending left over from 2023 that is going to be carried over to 2024. So they have that little bit of buffer. But the fact that they are basically saying the budget deficit for the general account to GDP is going to stay the same tells us that they're not necessarily going to have a big bang stimulus.
Steve, some more lines dropping again from that local media. Lina Zhaobao again talking about the sovereign debt issuance, because this was something else we were tracking quite closely. And what we're hearing is that it's going to be 1 trillion yuan. That's a lot lower than it was the year prior. We're also getting confirmation now that the GDP growth target will be at around 5%. But just shifting back again to that special government debt issuance, it does seem to Heidi's point as well, a lot more restraint coming through.
Yes, and I think that is how the government has been telegraphing how they're going to handle the fiscal situation, or the debt situation, actually. They're not necessarily going to ramp up the fiscal stimulus as they have in years past. That was the old cocktail. Basically, incur lots of debt, especially at the local level in the provinces, and then deliver, spend your way through debt out of economic slowdowns, like in 2015 and in previous slowdowns. They're not going to do that. And that they've been saying that, and they're telegraphing that, and essentially going to reconfirm that here at the NPC, I presume, in the work report coming up in the next hour. Again, the provinces are severely constrained on their fiscal books. Their books their coffers are not full, right? Property market has really translated to a considerable drop-off in land sales. They cannot replenish their coffers there. The central government here in Beijing has given no indication that they're going to fill the coffers. And again, COVID zero. I know we don't talk a lot about that, but COVID zero absolutely hammered the books at the provincial level. They had to pay for all the testing. They had to pay for all the lockdowns. They had to pay for everything, not the central government. And it costs a lot. So the fiscal positions at the local level is constrained, and the local government does not want to exacerbate that with incurring a lot more debt.
Yeah, Steve, I think it's just that big question of how the markets respond to the prudency as well, and that prudent approach. But that was Bloomberg's Steve Engel. We'll be back with you in Beijing later. But more ahead, we'll have analysis on China's economy with the MPC getting underway in Beijing. The Lowy Institute, Richard McGregor, shares his views later this hour. This is Bloomberg.
All right, well, we've taken sort of some of the anticipation, I guess, out of that work report, but certainly investors will be looking for more details around this China 2024 GDP growth target of around 5%. You're seeing the participants ranging from top military brass to political representatives headed on what looks like a cold, rainy day in Beijing into the Great Hall of the People as we see this sort of political pomp and pageantry begin to take place in the nation's capital, that is Tiananmen Square, headed into the Great Hall of the People, really the epicenter of political power in the world's second biggest economy. What we are watching, though, is that around 5% is the same target that we saw for 2023, but arguably the economic challenges are steeper than before. The social challenges are harder than before as well. We're not coming out of that post-COVID reopening bump that was expected, that was very short-lived, and we saw the struggle for policymakers to be able to make that growth target even for 2023. So to set that for 2024, no doubt policymakers are hoping to instill some confidence, some much needed confidence, and lift sentiment for investors and foreign investors in particular. But the question is how they're going to support that when it comes to fiscal support. We know that this is very directly correlated, the GDP target, that is, to the labour market. They're hoping to aim to add 12 million urban jobs in 2024. The fiscal number, Bell, is the one that's interesting to me. That fiscal deficit, we hear that it's at 3%. That was the original number for 2023 that was revised up to 3.8%. How they plan to support that 5% GDP target without adequate fiscal expansion is the question for me.
Yeah, the key message, I think, Heidi, coming through so far is that we're seeing a lot of restraint here in terms of government spending plans. And as you say, that target, especially when you put those base effects into the story here, it is going to be extremely challenging for Beijing to be able to meet this. Yes, as you said, that investment reaction, how our trade is likely to respond to this, because we had seen that real call for more concrete policy steps, for further stimulus to come through. And given that picture of restraint, it certainly could be perhaps a bit of an not a great setup for markets so far, although we do tend to see them trading higher ahead of the MPC. This has been something we've been speaking to a lot of investors about, of course. Are they likely to put money into Chinese equities? Given those moves that we have seen over the past few weeks, Goldman Sachs is one that we spoke to, the CIO and head of investment strategy group. This is her view on whether now is the time to put your money into this market.
Given how cheap China appears, people inevitably say, well, has it discounted the worst news? And our view is that one should not invest in China. First and foremost, we think the economy is going to steadily continue to slow down for the next 10 years. That's a very important factor. Second, when we're looking at policy uncertainty, it is not clear what the overall general direction of policy will be long term.
Also sharing that bleak view on China is Rabini Macro Associate CEO Norio Rabini. He told us where he sees longer-term structural issues with the world's second biggest economy.
I'm more concerned about China than Europe. Europe has been in a pretty much stagnation for the last few quarters. The same thing with the United Kingdom. But think of it, given the shock that came from Russia, Ukraine, there could have been a real hard landing. Instead, they've had flat economic activity for the last 4 or 5 quarters. The other problem with Europe, of course, is aging, lack of technological innovation, and things that are more structural. China, I think, is a more serious story because Chinese potential growth used to be, for 3 decades, 10%, then went to 5%. I would say most people now estimate the potential growth for China for the rest of the decade is going to be between 2 to 3%. It's a story not just of aging, it's a story of state capitalism, it's a story of less FDI to China because of geopolitical stuff, a story of less export-led growth because there is protectionism all over the world. Consumer and business sentiment is in a funk, in part because of the policies of Xi Jinping. And finally, consumption is low as a share of GDP, and savings are high because you don't have a social safety net. People have to save for old age, for retirement, if they get sick, if they get unemployed, the migrant workers don't have access to public services. So there are really structural reasons why growth in China is going to be 2-3%. And that's a real shift for the global economy.
Is that a disinflationary shock or an inflationary shock for China to be growing at a much slower pace?
It's disinflationary for China, and we already see it in the data. There's also disinflationary for the world in 2 ways. First way is that essentially China is dumping on global market all this excess capacity. And of course, the Chinese currency weakening means that other currencies are appreciating, and that's also deflationary. And finally, if China is growing less, demand for commodities, everything else equal, will be lower, and part of the global inflation for the last few years has been commodities. So overall, a slowing down China is deflationary for the global economy.
Does that economic malaise risk a more assertive foreign policy coming out of the CCP? Is that what you'd expect?
I'm not sure, because they had a very aggressive foreign policy, but I think they've realized right now this kind of a wolf warrior policy doesn't make them friend in Europe or around the world. They have to worry about economic growth. The National People's Congress is right now. They're very insecure. And the reaction to the Taiwanese election has been actually relatively moderate. They could have been much more aggressive. And I think they realize in a situation like this one, escalating tensions with the US is not good for them, it's not good for relations with Europe, and they're taking a slightly more cautious approach. I think they're really starting to worry about the economy, about the stock market, and probably, after the Xi Jinping and Biden meeting last fall, there's been a beginning of something of a thaw. I don't think it's a strategic change. There will be continued strategic competition between US and China. The Cold War is going to be like this, but probably for the next 12 to 24 months, the relationship are not going to escalate in the negative direction because they're worried about their economy.
You mentioned the NPC. Can we see any more stimulus coming out of the Chinese government?
Some people have suggested that they should have much more monetary and fiscal stimulus. Xi Jinping and most of the policymakers are resisting it, in part because there is already too much debt and deficits, and doubling down on credit fuel fixed investment is going to be dangerous. But I think that even Chinese realize that the slowdown of growth is structural, is not cyclical. And if you do more monetary and fiscal stimulus, you increase debt, you have a short-term boost to growth that's only short-term, and you're creating more debt and leverage and more financial risk down the line. So there will be some stimulus, because without that stimulus, their target of 5% for this year is not going to be achieved. I think potential growth already in China right now is less than 4%, but I see growth this year being closer to 4 rather than 5. There'll be some stimulus, because without it, growth becomes on a 3 handle. That's something is politically not acceptable, but not as much stimulus that get you to 5%. So something in between.
That was the Rabini Macro Associate CEO Norio Rabini speaking to Bloomberg Surveillance there. And the big news we're getting at the course of this hour really relates to China's NPC. Given we've got that growth target now being announced at around 5%, something that's going to be very difficult for policymakers to meet. We've also got their plans around the budget deficit, and that's going to be set at 3% of GDP as well. Other top headlines that we're tracking from that relates to the employment outlook, and they are planning to add, or aiming to add, 12 million urban jobs over the course of 2024. We're not really seeing too much of a reaction so far in the offshore yuan, but certainly that outlook for equities is going to be very interesting when we have mainland markets starting to trade in about an hour's time. Bonds as well. We've seen Chinese bonds, again, little changed off that. So that is the outlook we're seeing there. As we said, that NPC planning the budget deficit at 3% of GDP, the growth target set at around 5% for this year. And you can turn to our T Live for more on this, get more analysis from our expert editors and reporters. All right, you're watching Bloomberg this morning, Daybreak, and taking a look at what are really the key headlines that are dropping so far from the NPC over in Beijing. Here you can see that 2024 growth target has been set at around 5%. This had really been predicted by many economists, but actually it's a very high bar. Yes, it's the same, but 2023's growth was measured against an economy that was still under COVID restrictions, so it had base effects playing into it. This is really a target that is quite ambitious, and playing into that, of course, you've got the budget deficit target coming through. That's around 3% of GDP. But the fiscal restraint, that's also being reflected so far. Jobs-wise, they're planning to add 12 million jobs over the course of this year as well. So targeting urban unemployment of around 5.5% for these coming 12 months. So let's get more on the market reaction to that. We're just under an hour away now from the start of trade, bringing in our stocks reporter, Asia stocks reporter, Jeannie Yu here. And Jeannie, I'm curious for your views on this, because, yes, as we said, it's quite ambitious, this GDP goal. We don't have a lot of spending coming through. It really does appear to be a picture of fiscal restraint so far. How do you think investors are going to like the sound of this?
Yes, in general, I think 5%, which is similar to last year's growth, but as you just mentioned, it means China needs a lot of forceful measures to really prop up the economic growth, given that, from consumption to manufacturing, like none of those are really satisfying. So I think investors would treat 5% as a good figure, and it would aid the market sentiment, because what the market has been feel a little bit disappointed about since December last year, the Central Work Economic Conference, was that there has been a lack of real big physical and monetary boost. So I think after the NPC meeting, what the market is expecting at this moment is that China is going to step up their measures to really boost the economy. So I guess that's a good message that the market has been waiting for. But having said that, we only have the top line figures, but we need to know like more details, especially like how China is going to handle the property crisis, how they're going to narrow the gap with the U.S. in terms of the AI competition, the chip production. These are all big question marks that needs to answer by the MPC meeting. So eyes are really close on all the details from the MPC work report at this moment.
Jeannie, we may not get the answers to the level of detail that we might be accustomed to, right, given that Li Qiang is not giving his press conference. How much does that matter in terms of creating more opacity for markets?
Yes, I think that's a really big surprise to the market, and I don't think investors are taking that really positively. But there were a few theories about that. So one theory is that China has yet to come up with a complete plan to really, in terms of tackle the economic weakness. So it's a matter of time. It's not like Li Qiang doesn't really want to answer reporters' questions at this moment. So I guess market may treat this as a wait-and-see attitude. So there's, I think, all the signals from the MPC work report still like would dominate the sentiment today, versus the absence of the press conference hosted by the premier.
Bloomberg stocks reporter Jenny Yu there. Well, China's Premier Li Qiang will be delivering his first work report to the National People's Congress in about 30 minutes' time. Investors will be watching for any signs of fresh policy direction for the economy. Rich McGregor is the Senior Fellow for East Asia at the Lowy Institute and joins me now in Sydney. So we've got the sort of the headline numbers, right? Around 5% again for GDP, 3% for the fiscal deficit, same as last year, maybe a little bit optimistic given that was revised to 3.8%. We just got confirmation of defence spending, 7.2%, a boost there. Any surprises in that for you?
You know, the MPC is all surprises, no surprises. I think people had looked at about 5% because we've already had a number of big provinces and cities put out their estimate, and it's all around 5%. So that's as good an estimate as you'll get. As your reporter said, it is quite ambitious. People will be sceptical of the ability to meet that, even if it's met nominally, in other words, the announced growth rates. So I don't think it's surprising, but it doesn't come, as you say, with any detail. And it's very, very disappointing, I think, that Premier Li Qiang won't hold a press conference. That has been a really terrific platform for many premiers in the past to set their mark on economic policy making, goals, determination, willingness to, make certain reforms. And so what a terrible message to send, to have that wiped from the agenda.
And, as Stephen, we were talking about earlier about, it's not just to be able to communicate the economic goals, but also it's almost sort of the warmth of communication with the Premier, right? And we know that Li Keqiang was in a lot of ways a very beloved figure in China. Li Qiang, this was going to be his kind of first time to take that stage. How do you think that, what does that tell us, I guess, about how Xi is managing his top cohort?
Yeah, I mean, in the past, Zhu Rongji, Wen Jiabao, to a lesser extent Li Keqiang, all used this platform to push various ideas. Li Qiang has an excellent record as an official in China, running very big cities, a lot of involvement with the private sector. And I was hoping, maybe naively, that because he's a Xi person, a Xi loyalist, that Xi would give him a voice. But that doesn't appear to be the case, and so we just don't really know what the 5% is made up of. Fiscal deficit, I don't pay too much a problem with that. China doesn't have a big problem with fiscal deficit at the central level, and if there is to be stimulus in the traditional way, it's done through banks, not through spending in the Ministry of Finance bottom line. So that doesn't really tell us much. The big issue is confidence on many levels. We've still got to look out for whether there's a big bailout, that may be the wrong word, or an attempt to sort of get property debts into, park it somewhere and rebuild the property sector in that way, not to the good old days, but sort of, build confidence back in the economy. And I'm not saying it can't be done, but we don't see signs of it today so far.
And it's a time of trying to build confidence when a lot of the structural reforms are inherently contractionary, right? Sorting out what happens with a structural slowdown in the property sector that in a lot of ways needed to happen. Getting the indebted provinces and regions under control as well. How do they balance those priorities?
Well, it's going to be very difficult. We hear lots of stories these days of big cities in China, or smaller cities, running out of money. Can't pay teachers, can't pay nurses, can't pay police and the like. That in the end is not sustainable. Of course, the central government doesn't want to bail them out. They've got a sort of tough love policy. They say the debts are your fault, you fix it. And so that really means, as you say, that is contractionary. Exports, people say, I think exports is a very positive sign for the economy, maybe not for the European car industry and the like. But, China's export sector is fantastically competitive, but I don't think they can grow out of current problems with exports. I mean, they're doing very well in some areas, but they're not, technology won't grow the economy by itself. There has to be a boost to consumption. People have to be reassured on many levels to give us that boost. We're not seeing that yet. I'm not too pessimistic about the Chinese economy because there's lots of ways they can return to substantial real 5% growth, not led by investment and exports.
By removing the sort of key voices that could really engage with the public and offer that reassurance rather, how as well do you think that sets us up for some sort of misinterpretation at more of a local government level of that main party message?
Yeah, it's interesting because, of course, if I remember correctly, Li Cheng went to Davos and gave a pretty, positive speech or rah-rah speech about the Chinese economist at the Davos set. The Premier's press conference traditionally, I don't think most Chinese people watch the NPC. They certainly watch the Premier's press conference, though. And that's a message, as you say, not just to the world at large. It's a message right through China down to every locality and the like. Somebody that officials there can look up to, listen to, take their cues from. And so I don't see the point of it being diminished in that, that role being diminished in that respect. So yes, it means less open, clear communication.
And it does give that sense, I think, that there's sort of less influence as well for those other key party officials. And President Xi, we know he's someone who's consolidating his power, but what's sort of the side effect of that when you have perhaps someone who's stretched too thin with just so many responsibilities?
Yeah, I think I've been trying to keep an open mind about this. All of the Politburo members of Standing Committee members are all loyalists to Xi, all identified with Xi, and that's most unusual in Chinese politics. Even Mao, Deng, people like that, always had people who were identified with different networks, rival individuals, and the like. And in some respects, you could say, just because you're a crony, does that mean you're a hack? Not necessarily. Many of these people have, substantial governing records, and it's possible that Xi trusts them. He would give them more, ability to speak and the like because he doesn't feel threatened by them. But that doesn't appear to be the case. Once again, we've got, the voice of God in China, one person, and we have to watch what Xi says, and it's very difficult or harder to take your cues from other people.
What else we've been hearing about in terms of personnel is that we're not going to have any sort of moves being announced over the course of this week. Is there anything to take from that?
Yeah, that's a harder one. Has been a lot of speculation, as you know, that China would finally get a new foreign minister. Wang Yi has been doing both jobs, foreign minister and also the foreign policy representative in the Politburo at the moment. It's too much, obviously, for one person. From my experience, it's always absolutely perilous to ever make any personnel predictions in China because you never know what's going to happen. It's tightly held.
but there's still a need for a foreign minister. The NPC would have seen a logical time to do that. Qin Gang, I think, has formally resigned from a different post now. It's still possible we'll get that in a few weeks. It may be Liu Jianchao, the head of the International Liaison Department, but once again, it's not very clear.
It's interesting, right? There is a sense by keeping Wang Yi there, to steady the ship, if you will, he's sort of trying to deal with one major problem at a time. Do you think the personnel purge is done?
Well, that you'd never say never with that, I think, because each time we've called an end to a cap on the anti-corruption campaign, then the more sort of big wigs fall. We saw that with Qin Gang, we saw that with the defence minister last year, we saw, I think, the Bank of Beijing. This is sort of the history, the anti-corruption campaign still going through aspects of the financial industry, because once you turn over one rock, you find something else which you have to pursue. So I don't think so, actually. But in the case of the foreign ministry, Wang Yi has an extraordinary set of duties, which is too much for any single person. He still has to lead policy maker, as it were, or lead policy convener under Xi. He also has a very hectic global travel schedule. He's going to be down in Australia and New Zealand in a couple of weeks, for example. Would probably go to a Pacific country on the way. It's too much for one person. China has many, adept, articulate representatives who could do the foreign minister's job. It's not clear to me why they're not filling it.
You'd imagine they would want to have someone in place by the time November rolls around. What sort of challenges do you see if we were to have another Trump presidency? And I do wonder how quickly the issue of Taiwan could come to the fore if there is a change in, US's support of Ukraine, for example.
Yes, on one level, for example, we have a sort of kind of diplomatic reprieve this year while everybody waits for the US election. On the other hand, there's lots of big things that are going to be happening. For example, the inauguration of the Taiwan president, I think in May, from memory. China's been quite quiet since the January election. I don't think it's going to stay like that, depending on what the Taiwanese say, depending on what the Americans do. The essence of Trump is not that he's weak, strong, whatever, is that he's totally unpredictable. And the idea that China would welcome such an unpredictable president, I don't think is true. He may be presiding over the disintegration of US politics, but the US is enormously powerful, and Trump can destabilise China as he did last time. So they have to gird their loins for that, as indeed we all do.
On that note, Richard, always great to chat with you. Richard McGregor, Senior Fellow for East Asia at the Lowy Institute. You can also turn to your Bloomberg for more on China's NPCT, LIV Go. You get that commentary and analysis from Bloomberg's expert editors as we await more details in the Premier's work report. More to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia, taking a look at the price action we're seeing for markets so far. We do have China setting its growth target at around 5% over the course of this year. They're also planning to add around 12 million jobs. We're getting details on special local government debt issuance, defence spending as well. So a lot of headlines dropping ahead of that work report announcement at 9 a.m. Beijing time. But the market action today as well, really reflecting the US moves overnight, because we saw Wall Street just drifting a little bit slower ahead of Powell's testimony. We've got some key jobs data ahead, but that's the state of play there. What else we're tracking, of course, is the inflation picture in Japan, because we have price growth in Tokyo surging back above the BOJ's target in February. The figures are leading indicators of the national data that's due to be announced later this month. But let's get more from our Asia economy and government senior editor, Brian Fowler. And Brian, I'm curious, how much do you think this is base effects, or do you really think it's something that's resurgent price pressures?
Well, there's a lot to unpack. I mean, a lot of it is base effects. So a year ago, the government rolled out these subsidies to put a cap on the cost of utilities. That took about 1 percentage point off of inflation a year ago, so much of that did come back this year. And by the way, those subsidies are still in place and will remain so till the end of April. So we may actually see a little bit more of a bump in inflation from May. But in terms of other components, so food prices continue to rise, albeit at a slightly slower pace. And then other components, lodging, which is of importance to anyone who wants to visit Japan right now, hotels and inns, the cost of those actually sped up to about 33%. So we're seeing factors kind of pushing inflation up from various corners of the economy. And we also do have, I mean, energy prices are actually still falling, just at a much smaller pace than they were a year ago.
Given that low base effect and the fact that maybe it's not the most stable of comparisons, will the BOJ still be doubling down on its need to see wage growth as a key factor in its timing here?
Well, Heidi, I think that is the case. The BOJ definitely wants to see those wage numbers, and it actually can afford to do so because we expect to see a big batch of those results coming by March 15th. And of course, the next big BOJ decision is on the 19th. So the BOJ can afford to take a little bit of time and wait for those numbers to come out. Having said that, speculation is all over the place in terms of whether this big move is going to come in March or next month. If you look at overnight swaps, we began today with about a 36% chance of a hike on the 19th. After those Tokyo CPI stats came out, that shot up to about 45%. I looked a little while ago and we were back down to about 29%. So a lot of factors kind of swirling around, pushing around notions about what's going to happen.
Yeah, and we certainly know that traders have been agitating for change for quite some time. That was our Asia Economy and Government Senior Editor Brian Fowler there, and we'll have more ahead on Daybreak Asia. This is Bloomberg.
Let's get straight back to our Chief North Asia correspondent, Stephen Engel, who is outside the Great Hall of the People in a very wet, rainy and cold Beijing. And Steve, we've been passing through these numbers, around 5% for the 2024 GDP target there, 3% of the fiscal deficit. Interestingly, 7.2% for military spending. Maybe I'll start off with that one, actually, for you, because the constant sort of re-upping of military and defence spending has caused a lot of consternation for other major economies around the world.
Yeah, I think this number is going to be standing out to the international press a little bit because, again, the GDP growth target of around 5%, not too surprising. Obviously, that's what it was last year. Obviously, 2023 was very difficult for the Chinese economy, but they believe that they can kind of stoke some domestic demand without necessarily further exacerbating the debt loads at the local level. And again, the CPI target of around 3%, that's pretty consistent with what they've done. That would be a pretty good achievement if they can get that at a time of persistent and perhaps heading towards entrenched deflation, at least at the factory gate on wholesale prices. But yes, retail prices also, CPI has been in deflationary territory. So they feel they can reflate a bit on those CPI, the consumer price index. But the military spending, an increase of 7.2% to the, it's basically the most in 5 years, is interesting at a time, obviously, there's geopolitical tensions, a lot of talk and rhetoric over Taiwan. Obviously, as we just came out of that very pivotal election in January with basically Lai Ching-te of the more independence-minded DPP winning a third consecutive presidential term. He didn't win, the party did, obviously, for the third consecutive term after Tsai Ing-wen. And of course, the modernization trend of the People's Liberation Army obviously needs the spending. And now, clearly, in this work report in the budget, they're going to get a biggest increase in 5 years for military spending. So, yeah, I think that's the one main number that a lot of people, at least internationally, will be circling, as well as the ratio to, the budget deficit as a ratio to GDP at just 3%. That's another interesting number. We thought it was going to be a little bit higher. Yes, there's carryover fiscal spending from last year, but again, the fact that they did not necessarily raise that budget deficit ratio tells us that they're not going to throw everything at on the fiscal side towards a recovery.
Yeah, and Steve, just as you're talking here, we're getting pictures from inside the Great Hall as we await that report announcement. But as you said, that budget deficit, yeah, really interesting, coming in at around 3%. How much do you think that this is sort of a picture of fiscal discipline?
It is fiscal discipline. That's everything. One thing I've learned, I guess, about President Xi Jinping is he usually follows through on what he says. And he has been trying to put together, fiscal responsibility, fiscal discipline, high quality development. He said that terminology 128 times in 2023, twice the number of 2022. So high quality development, in my reading, is okay. We can accept lower GDP growth, but it has to be sustainable growth over the long term, and it has to be responsible growth.
All right, that was our Bloomberg Chief North Asia correspondent, Stephen Engel, and we will certainly have more ahead from you in Beijing as we await that report. And we're going to be continuing our coverage of China's NPC. As we said, that's opening in just a few minutes' time. We're going to be joined by Tsinghua University and also UC San Diego's Victor Shi. That's it from Daybreak Asia.